Good evening, everybody. This is Kirk Spano. It is Tuesday night, August 31st. Ask me anything. And I'm going to ask the first question. The first question is, will AMC go to the moon? Will the apes from Reddit win? Are there millions and billions of synthetic shares on AMC floating around the finance verse, just waiting to flood into the market to blow up those horrible shorts who are colluding to hold the price of AMC down? While the good guys, maybe the good guys over at Reddit, collude to push the price up of a worthless bankrupt company that has more debt than it can ever hope to repay. That's actually going to be the topic of another program. I just thought I'd give you a warm-up because I've been reading up on AMC because people are asking me about it. And I think it's hilarious that people want to chase a bankrupt company. But if you want to do that with your risk capital, if you think that you can outtrade the market, if you think that you can outlast the hedge funds and all these big institutions that are betting against AMC, when the market starts to get a little tight on liquidity, good luck to you. Tonight, we're going to talk about relative performance and go through some of the things that are available at margin of safety investing that are also available at fundamental trends. We're going to talk about the plug and play stocks, the very short list, and we will use all the links and margin of safety for the new people who just signed up so that you can see how it's done. But first, Stock Rover, where I do a lot of stock screening, and I have the S&P 500 here, and I have it ranked by 2-year return versus the S&P 500. In order, we can see that really these 30 years old stocks are all of the returns of the S&P 500, literally all of the returns of the S&P 500. I just want to show you that these are the leading stocks in the S&P 500, about 200 that have beaten the market, about 300 that have not. Actually closer to about 175 and 325. I just want to show you something that's interesting. These are all the leading stocks. This is the dividend column. I would just like to point out, you may not see something here. What don't you see? You don't see a lot of the big dividend stocks leading the stock market, do you? What happened? There's a myth that dividend stocks beat the stock market. That hasn't been true since the financial crisis, and was barely true from about 2000 to 2008. From 2008 to now, dividend stocks have not been the best place to be in the stock market as a group. So that's 13 years where dividend stocks have not been market leaders. What changed? Quantitative easing and interest rates near zero. That has been monumentally good for growth companies, for companies that need cheap money, for particularly growth companies. So a question I think that everybody should ask is that going to change anytime soon? Are we going to see interest rates anywhere close to the historical norm of about 5% on a 10-year treasury? Does anybody believe that'll happen in the next decade? And if it does it happen because there's some sort of economic shock? If there's some sort of economic shock, does it really matter what stocks you're in at that point because everything goes down? So, make the point just a little bit more clear. Here I am ranking the dividend payers in the S&P 500. So this is all the S&P 500 dividend payers with a dividend of at least 0.5%. Rank ordered by the size of their dividend. So let's go take a look at their relative returns against the S&P 500. An awful lot of red, don't you see? A couple exceptions. AbbVie, the new Dow might be a winner. Not on 10 years, not on 5 years, not on 2 years. There's been a little bit of rebound for some of them in the last year, mainly because everything went up that got its debt refinanced. So a lot of these companies are high debt. In last March and April, when the Fed liquefied the corporate bond market, they all got a reprieve. They got to push their debt out about 5 years. So now debts that were due in 2020 and 2021, 2022, We're now due in 24, 25, 26, and some of it even a little longer. But the Fed really focused on pushing debts out 5 years. So here's a question I have for you. These are companies that they have some positive 2-year returns, but for the most part, even in the last year, haven't beat the market. About 50-50, a coin flip. So do you expect this to continue, or do you think it goes back to this? For most of these high dividend stocks, we're trying to confuse people with a high dividend in most cases. Say, oh, look at our big fat 6% dividend. Don't mind the fact that the company stock doesn't ever go up. Do you think we'll return to this? Or do you think this is the new normal? Can't really get any more clear than this. You start to get into about this spot where the dividends are lower, around 3%. You start to see some of the companies beating the market, but what do a lot of them have in common? What is that number? Buyback yield. Companies that buy back shares, typically the ones that do best. Seagate, the stock that I actually just added back to the plug and play, acts in an essential duopoly. Let's take a look at buyback yield. Charlie Munger used to say he really likes companies that eat their stock. I paired that with dividend coverage ratio. Let's take a look at the returns. Hewlett Packard, remember, they had a giant transformation about 5 years ago. And then boom, they started beating the market. Seagate, West Diagnostics has not beaten the market until COVID. Even though they buy back shares, they have a huge dividend coverage ratio. Why don't they beat the market? Who knows? Sometimes something that looks like it should be beating the market doesn't. It's just the way it goes. A lot of these companies do beat the market. While it's not a hard and fast rule that buying back shares will drive up your stock price, you see that a lot more of these companies are beating the stock market than when we rank ordered it by dividend yield. These are all the companies on the S&P 500 with a dividend yield over 0.5%. Does it look like the big dividend yields beat the market? So when people start screaming, but Lumen and AT&T are going to cut their dividends, I hate them. I hate them. Maybe they're onto something. Maybe cutting their dividends to invest in their business, get rid of non-core parts, and increase their buyback yields, which they've both promised to do in the next couple of years. Maybe that's the right thing to do. So I am in the process of a major upgrade to the very short list, and I'm using relative performance as another quant factor that I've always used, but I have focused a lot on the smaller companies and the growth companies this year. And prior to that, it was a lot of companies that were hard asset companies, Nutrien, Newmont Mining, Freeport-McMoRan, things like that. And then technology is always there too. I understand that a lot of you don't want to wait 2, 3, 4 years for a small company to become a big company, because it's just too long to wait 3, 4, 5 years for a company to go from 10 to 50, right? If it's a hockey stick, you might be 10, 10, 9, 11, 10, and then bam, it goes up triple in 1 year. But waiting for that year for the hockey stick, people are like, well, I should put my money somewhere else. The problem with that is you never know when the kink in the curve on the hockey stick is going to happen. And the first move is usually fast and big. You can go from 10 to 12 to 20 really quick in a matter of days. And if you're not in time in the market, you'll miss it. So in a lot of cases, just buying the cheap company with a great outlook, getting to know the company rather than looking at the red and green every day like you're some sort of a zombie, probably a better approach. Learn about your companies. Learn why I'm high on a lot of the companies that I'm in that are trading at $8, $9, $10 a share, $12 a share. They're not all going to triple and quadruple and quintuple and be 10 baggers, but several of them will be. A lot of it comes down to management execution And in some cases, somebody will come along with a better mousetrap, in which case you try to cut your losses quick. So the new VSL, same link, I got rid of 2 columns. I got rid of the top of the buy zone box because that was kind of a moving target. And updating this spreadsheet over and over and over again became a major pain. In addition, I know that people look at the spreadsheet that really aren't supposed to because friends share the link with them. I don't care so much if people see my watch list, and I don't even care so much if they have the bottom fishing information because this doesn't hit very often. It really only hits when there's a pretty large correction in the market overall. And I have to update an awful lot of these. These are older numbers. Like Comcast, I don't think really is 33 anymore. It's probably in the 40s. Cisco, though, if it's not italic, that means I already updated it. If it's italic, it means it's waiting for an update. And I should be able to get to all of these in the next 2 weeks or so before the September option expiration. I don't have a link to the charts anymore because, again, I'd rather have those in the articles. A couple of these, Google doesn't have Kazoo yet because it just turned to this symbol last week. So I'm sure this will be up and running next week. But when we go through our list, our watch list, see there's a handful of stocks that are below their bottom feeding. Here Therapeutics, they have a drug that's a replacement for opiates. Soaring Eagle acquisition is not quite there yet, but On Track is. I think On Track is a screaming buy right now. AST Space Mobile was just about at the bottom fishing price, and it jumped up about $3.50 in the last week. So again, from its bottom, because it did get down to like 757 or 758, it's up 50% in a week or two. Open Door, it's below its bottom fishing price. I know people want to say, oh, they're going to buy houses and lose on buying houses. Look, if any of you know people who flip houses, make a ton of money, that's what these guys are going to be doing a lot of. The idea that using technology, they can't do it better and in mass is kind of mind-numbingly dumb to me. Yes, they'll overpay for a handful of houses, but some of the houses they get will be dirt cheap. But some people will try to game them, but hey, there's inspections. So you know they make an offer on a place, inspections can knock the final price down. Just like anybody else who's buying a house. I'll give you $250,000 for your house, subject to inspection. Inspection comes in, hey, this, and this need to be fixed. We're not going to give you the right to cure, but we will reduce our offer by X amount of dollars. Would you like to take it? Or do you want to put this back on the market and deal with all that again? In most cases, people go to Open Door Technology because why? It's easy. They get a fair price, they get it quick, they don't have to haggle with a lot of people, they don't have to pay 6% to an agent. So in a market that doesn't sell itself, Open Door has a huge advantage. In a market where everything sells for cash offers, no inspection, they'll have a little harder time. And if you believe that that's going to be reality forever. So in any case, this is going to get upgraded even more as I take out some of the companies that just aren't cutting it. A lot of it based on relative performance. And the fact that I know most turnarounds, and you should know this too, don't turn. So we want a list that's 80% companies already doing really well. You really only want maybe 1 in 5 of your picks to be turnaround stories. Sexy as those are, when they hit, 4 out of 5 stocks that you have should be companies that are, hey, they're just grinding it out and they have something that's coming that can make it even better. Oh, look, I highlighted one on accident. So when you go to take a look at the plug and play stocks, which are just derivative of the VSL, which is the big watch list, this is one of the bigger updates I've done in a very long time. So we have our charts. Take a look at Microsoft. Again, it's just a beast, just a beast. And pullbacks will normally be relatively small, except when the market corrects. When the market corrects, you really want to take advantage of that. So this price right here was the pre-election QE. Remember, back in September 2019, the repo market started getting in trouble. So that was actually the first batch, $1 trillion of QE. Then coronavirus, and now $5 trillion of QE. They're going to turn off the QE over the next year. That's what they say. I don't think it'll ever get completely turned off, to be honest with you. I think they'll get it mostly turned off, and then something will happen. In any case, it's hard to get Microsoft when things are cheap. And when the price is up here at $300 a share, people are like, well, it can't possibly come down to 200. Why not? Why can't the price come back down into here, which is more in line with the slope it was on? And if it does, you're going to want to buy it, right? Why? Because it's a beast. And two, whenever there's a recession, they'll put more QE in the market and you get another run. So you get something super high quality, pays a dividend, buys back shares, leads the market over long periods of time in all sorts of oligopoly businesses. Cloud is expanding. The data from the satellites is going to expand the cloud. Not a lot of bad things you can say about Microsoft's future. Correlated corrections is when you get to buy the beasts. So some of the beasts like Alphabet, Amazon looks like it's getting ready. Little correction and then big rally. Rivian is going to make them money apparently. The EV revolution is going to make them money. They're going to spin off the cloud services eventually. Not a lot of bad things you say about Amazon other than probably going to have a hiccup. When they have that hiccup, pat them on the back and buy some shares. They're a beast. But again, probably should get into this price range. This is where I'll explain a little bit. Buy zones. Yellow is just a broad area where you'd expect it to get to at some point. Orange box is where I'd be really interested in buying the shares. But granted, if we had Armageddon in the market and stock price came way down here, I'd back up the truck. But we can see on a weekly chart, it's overbought. On the RSI, the MFI is overbought. And then the shaken money flow is just starting to turn over. That's called a negative divergence because it's doing something different than everything else. Everything else is still a little bit uptick or maybe flat. This one's flattening, this one's flattening. Shaken money flow, quantitative measurement of money flows into the stock, demand for the stock, starting to turn over. I'm going to get a correction. Does it go to here? Become interesting? Maybe I end up buying some QQQ to hold some apple? Or does it get all the way down here where I want to take a bite of the apple? We'll see. Around 100, I think you probably have to take a bite unless downward momentum is real strong. If the downward momentum is real strong, then you wait a little longer. And about 90 bucks a share, man, it's a bargain. So I'm going to probably try to play a little bit of catch of the falling knife. I'm probably not going to try to catch the falling knife up here. Unfortunately, sometimes we get boing. My lines, you've seen it happen over and over again. Boing, they get these bounces. So when it gets close, you got to really pay attention that day to see if on the shorter term charts, the downward momentum suddenly ends some afternoon. And a lot of times it does. It takes 4, 6, 8 hours, downward momentum can end. So just because it's falling straight down, you'll get those 1 or 2 days where all of a sudden selling pressure just disappears. You have to ask yourself on those days, is this real? Usually it is. It has to do with algorithms. It has to do with limit orders. At some point, people just start saying, nothing left to sell. I've already got my cash. I've already paid my margin. All right. You get 1 or 2 days to try to catch these bottoms. And even if you don't catch the bottom, the world starts to get better, you can always buy it in here. So usually in this area, I'm not buying it as it's heading down. But if it comes down and starts to go back up, I'll buy it in this order, in this area. So here, I'm not going to buy it here. And as it comes back up, maybe I will. Get 2 tries. Berkshire Hathaway, same thing with these guys. Now, I don't always use the exact same lines for everything. In fact, there's an important line that I leave out. I don't know that I want people to know I'm using it. So if they see that I don't have it on here, they're like, oh, he doesn't know what he's doing. I know what I'm doing. But right here, about 240, Berkshire gets pretty cheap. And you know what happens down here closer to 200? Berkshire has a flexible buyback policy. They don't do it on a schedule. They do it based on the price. And down around here is about where they'd be buying back their shares based on history, recent history. At the last investor meeting for Berkshire Hathaway, what did they say? They said, if you just hold our stock, you'll do all right because we'll buy back the shares if it gets too cheap. What does Berkshire have? A big mountain of cash and tons of cash flow. Berkshire is probably the one that I would own instead of the S&P 500. So if I was an indexer, I was going to index in the one thing. It wouldn't be the S&P 500. It'd be Berkshire Hathaway. Why? Berkshire Hathaway has some ungodly number of businesses under its umbrella. They're curated. Maybe they're not perfectly curated, but they're curated and they've done pretty darn well. Berkshire's done okay. Warren Buffett's done okay. And they promise to buy back shares now. But Berkshire is one of the safer things you can own. Now, if you're a dividend investor, you're like, but they don't pay a dividend. And I would tell you, so what? So what? If you need the money, sell a share. If you're in an IRA, what difference does it matter? I think for the retired investor, for the person who fancies himself a dividend investor, what you learned earlier today, what you're seeing now, you should rethink about living on the dividends. Now, I think selling cash secured puts and covered calls is an awesome strategy because you can generate way more than a dividend and do it on better stocks. You can write covered calls and cash secured puts on anything. So why not pick out the better stocks, write cash secured puts and covered calls on these, because you'll generally generate anywhere from 5 to 10% a year in premium. And because of the way option selling works, you're reducing your risk. Remember, buying options is risky. Selling options is the other side of the bet. That's an insurance contract you're selling. How many insurance companies do pretty well? Most of them. They have underwriting problems once in a while. Underwriting problem at an insurance company, I would say, would be akin to accidentally picking out a bad stock once in a while. So you're going to make a lot more money selling options than buying crappy stocks with big fat dividends. They're going to have to cut those dividends someday in many cases. So the big fat dividend argument hasn't been the truth for a couple decades now. And we can see that that is not the factor that leads to better stock appreciation. It's buyback yield. And you want both. I mean, it'd be great to have a dividend and a buyback. Take a look at the businesses these companies are in. Take a look at the bottom. What are these companies in? A lot of oil and gas, utilities. I don't push a lot of utilities, oil and gas companies anymore. They just haven't performed well for a very long time. That's not going to change. You have the secular decline of oil and gas. And utilities are going through a massive capex period right now that's going to last 10 to 20 years as they convert from fossil fuels to clean energy. It's going to cost a lot of money. There's better ways to invest in all these trends than saying, oh, well, I'm a dividend investor. I want you to be a better investor. Think of yourself as, I want to be a better investor, not I want to be a dividend investor. Because there aren't a lot of great dividend stocks out there anymore. Now, at the start of this article, it tells you to read this article using the plug and play stocks. Gives you some examples, talks to you about diversification. I should use a bigger chart for that. Anybody who owns more than about 30 individual stocks, it's just too many. This chart says 50 is almost full diversification. As little as a dozen was pretty good diversification. So if you have a few ETFs and a dozen stocks, that might be all you need to do. You don't need to make it a collector's habit. I typically have between 20 and 30 stocks and several ETFs. Plenty of diversification. Because the position is a little smaller, hard to get blown up. Then finally, at margin of safety, you have price alerts, which I haven't entered yet. I erased all the old ones. I'm going to enter them. Now, here's the problem with the price alerts over at Seeking Alpha, is that you're going to get alerts for every stock on the list, whether you're interested in that stock or not. So my suggestion is that you do what the people at Fundamental Trends do, and you put your own alerts in the trading view or stock rover or at your brokerage or two of those three. Put something technical over at trading view, something fundamental at stock rover, and then just a straight price alert maybe at your brokerage on the stuff that you're interested in. So I don't know what you're interested in. Plug and play stocks will all be in this alert system over at margin of safety. Even though you might not like them all, you'll get an alert on every single one of them. So that's about, between ETFs and stocks, about 70 positions, give or take. So you may want to just do it yourself. But I will enter them here if you want to have alerts for everything that I'm watching. All right, do we have any questions today? If QE eases up, thereby firming the US dollar, doesn't that diminish the return on gold? Sort of, usually, sometimes, I guess would be the answer. Gold and the dollar have historically moved in tandem about a third of the time. 2/3 of the time they move in opposite directions. About a third of the time they move up together. Not really sure what the perfect explanation to that is. However, I would say this. We are at a unique spot where for the last year and a half, money that would often have flowed into gold and gold stocks has flowed into cryptocurrencies. And I think that that's going to change a bit. So I think a lot of the cryptocurrencies are going to zero. And you'll have Bitcoin, Ethereum, and 4 or 5 others maybe. And it'll be down to a half a dozen cryptocurrencies, plus a couple stable coins. So I guess we count those as cryptocurrencies. But stable coins are something interesting to watch. If those get regulated as money market accounts, which means that they have to buy US treasuries or other high quality assets, who's to say that one of the high quality assets that they're allowed to hold could be gold bullion? Central banks hold it. So I don't know what the rules are going to shake out to be. I wouldn't be too bearish on gold. I think that the last year is about as bad as it gets. The gold miners can go down when the stock market drops. If GDX goes down to the middle 20s, I'd probably be really interested in it. I don't really buy gold securities. I buy gold miners, but I don't buy GLD. So I don't buy the gold ETF because if I want gold, I just buy gold bars. I got a couple little gold bars, little ones. So I don't know that I would be too concerned about the price of gold going down. But if you're going to speculate on gold, you want to do it in the options market anyway, or futures market. So I wouldn't never buy GLD. All the futures-based funds, even the physical-backed funds, there's better ways to invest in that, is all I would say, is use futures or use options to catch the moves. Somebody asks, what do you make of the analyst referring to Apple iPhone 13 as satellite technology and potentially using Globalstar? No, I mean, we know that Apple, we've known for a year, that Apple is going to add a satellite-based emergency texting system into a future version of iPhone. Probably not for 2 more years. And the speculation is that they would use Globalstar, and I don't know where he came up with that. Oh, here's the thing. If the phones can connect to a 5G network via satellite, why would they use old technology that you have on boats, right? So what they're saying is that they're going to incorporate old technology into the cell phones for an emergency alert texting system. It probably wouldn't do voice very well, because to make an iPhone into a full satellite phone, you're spending a lot of money to use the old technology. But wait, there's new technology that will know whether or not it works next year. So if AST Space Mobile's technology works, does Apple even have to change their phones? I think it's very interesting that they're saying they're going to have a change about 2 years out. Maybe by next Christmas, but probably, or Christmas 2022, but probably not. So I think you wait and see. And I think there's a very good chance that if all the phones have the ability to connect to a 5G network via satellite using AST Space Mobile, why wouldn't they do that rather than muck up the engineering inside of their phone to add another piece based on old technology? So I don't know how I feel about the Global Star thing. I guess what that is if AST Space Mobile doesn't work, which is possible. Which is why I saw a lot of options on that one. So I want to get that one as close to a next to nothing cost basis as I can by the time we know whether or not it's going to be a rocket ship to the moon or if it's going to crash and burn. Anything else? Well, somebody asks about Berkshire Hathaway against the SP 500. Well, 10 years doesn't really make much difference to a stock that's been around 50. But more importantly, a couple of years ago, Berkshire Hathaway started buying its shares back, and they have a mountain of cash. So if you basically say the businesses in the S&P 500 and the businesses that Berkshire Hathaway are involved with are similar, I think that's fair. Roughly similar enough. The S&P 500 can't buy back its shares, but Berkshire Hathaway can. Which one would you rather have? If Berkshire beats most of the dividend stocks too, which is the comparison I made. So if you're a dividend investor invested in crappy stocks, probably better to invest in Berkshire Hathaway, which is much higher quality in most cases, and then just sell a share here and there when you need some money. Hope that makes sense. Anything else? All right, a lot more coming in the next month or so. I've got mountains of articles started. I've showed you that list before. I mean, literally like 160 articles I got started. So I'm just going through the list now. Not a lot of the stuff I do is new other than the week-to-week stuff. And the week-to-week stuff will be back next week after Labor Day. You know, during the summer, do a little vacationing, do it a little bit thin. One thing I would like you to take a look at is last week's retirement income options. I didn't label this as the monthly update, but this is the post expiration update. That's why it was so big, right? That's why there were so many in there. So next week I'll find 5 to 10 new options. I look for a couple tomorrow, but I'll find about 5 to 10 new options every week. And then after option expiration, we get these big updates. So take a look at that. I would encourage everybody who hasn't sold options before, unravel your brain if you think it's too hard, right? I know how it feels when you're like, oh, this twists my brain, it's too hard. I have the 2 links here, right? Just learn these concepts. Covered calls, and the one that I like, cash secured put writing. Because selling a cash secured put, if you really want to skip taking a starter position, I normally take a starter position and then write a cash secured put. You can skip writing the starter position, you know, buying the starter position, just sell the cash secured puts. And a lot of these will go up in price and you won't get them, but you get to keep the premium. And some of them will get put to you and you get it at a cheaper price than what it was today. I think that people, Mark says, selling options is straightforward. It's been great for me. I think that for people who are new to selling options in the options market, I always go, well, I've heard, right? The very famous, I've heard from them, or they said that options are dangerous. Well, buying options is speculative. Selling options is the opposite of speculative. You're basically the insurance company. You're collecting a lot of premium. Even when you have to pay off, you get something in return, right? So even if Observe Global, last week, if I had sold this October $15 put and got $1 for it, look what Observe Global just did last week. Boom. Probably the only day that that option hit, 1847, and now the stock's up $4 because they beat on earnings, which I've been telling you for 4 months it was going to happen. And I do apologize that I don't pound the table very often. I put something on a list, kind of give you an outline of what I'm thinking. Should take some time to look into it. If it's, something that could fit into your asset allocation. But I'm not going to do the rah-rah cheers thing that most of the other writers on Seeking Alpha do. Not going to be like, rah, 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 buy this stock, buy this REIT, buy this REIT, right? They all talk about buy the REIT, buy the REIT, buy the dividend, buy the dividend. I just showed you. Those aren't the best investments, but they cheer a lot and they sing. I think they do a little soft shoe, or some tap. That's all you need to know. A lot of dividend stocks don't do that well. So between focusing on quality and growth and buyback yield over dividend yield, but dividend's important, but buyback is more because they're shrinking their float. In Lamb Research, the third best stock over the last 2 years, shrinking its float. Burt McMoran and Al Marley, they rode the commodity pop. And I'd buy them both on a big pullback, but I don't want them right now. That Apple company's done okay. Applied Materials. You just look at the industries that have done well. MSCI is interesting to me, and that's going on the ESL, on the update. Skyworks should be on our list. BlackRock's done really well. I see changes in their business model, though. If you were with me a couple of years ago, you did well on BlackRock and eventually on Invesco. All right. Somebody says, so you sell put options to generate income and reduce costs. Yeah, pretty straightforward. And to buy stock, mainly to buy stock that I want. I mean, I generally want it to get put to me because that means I got a really low price and some income. But the second time, if I already have a starter position, then fine, let it run away. These companies that I'm in, if there's risk involved beyond average market risk, that means the upside is gigantic. AST, Space Mobile, is the perfect example because it's one of the only stocks that we own that could go to like $1. If their technology doesn't work, they're going to sell off, just sell the patents for whatever they can get. But if their technology works, I mean, it's going to be in the hundreds of billions of dollars, that company. I mean, it's going to be a 20 or 30 bagger. So I take a little bit of money and I say, okay, if this works, and I have a hard time betting against scientists, I'm going to have a little bit of AST Space Mobile. I'm going to sell a lot of options against it and play the volatility, try to get my cost basis as low as possible. And if that technology works, holy cow, did I make a lot of money. If it doesn't, I lost a few bucks. I can live with that. All right. Have a great night, everybody. And I'm just going to throw this out there for you. Remember I told you Bucks and 6? The Bucks are going to repeat. The Brewers are going to win the World Series. And the Packers are going to win the Super Bowl. So expect me to take 3 days off. All right, everybody, have a good night. And Labor Day weekend, Friday, this coming Friday, I will be doing a webinar. And I'll be talking about issues central to capitalism between labor and capital, what the Fed has done, and why you're going to see at least a little bit of normalization. Take care.